right, so today we are going to go over reverse mortgage. We've been talking about reverse mortgage quite a bit lately. I know a few of you guys have been having some files. I know Ian has a file right now. She closed a file. I know Alex had a file, but I'm not too sure if we're still what's going on, to be honest. I know Simon had a file. So we're just trying to get you guys to kind of get a little bit more familiarized with the reverse mortgage. So reverse mortgage, as you guys all know, it's for older clients, preferably 55 and older. So we're going to be going over the different programs. So reverse mortgage, when a borrower qualifies for the reverse mortgage, they don't have a monthly payment, a principal and interest payment that they pay to the lender. They just have to make sure they continue paying the property taxes, the homeowner's insurance, and HOA if they have any. Those have to be in good standing. And this loan becomes repayable. They have to pay it back when the borrower sells a home. They move out. So if their kids decide to move them into a senior living center, they have to repay back the loan, or if the borrower passes away. So there are 3 different types of reverse programs that are out there right now. Our HECM, which is our most common one, which is a home equity conversion mortgage. It is FHA insured, and this one is for homeowners that are 62 and higher. And because it is FHA insured, there is a maximum that they can qualify for. Okay. There's the proprietary with Finance of America. They call their proprietary programs HomeSafe. All other lenders, they will have a different name for their own proprietary. I know Money House doesn't offer any proprietaries. All they do is do HECM. The proprietary is non-FHA insured. This one allows for the borrower to be 55 years or older, and it can be they can qualify for up to $4 million. Our last program that has been newer, I would say, Finance of America was the first one that first came out with this program. It's their HomeSafe Second, which is a HELOC as a second lien. They keep their first current mortgage, and they would qualify for a second. The second, they don't pay, same thing as the reverse, they don't pay the principal and interest. It is a second lien, and they can do a lump sum of up to $1 million. I've seen quite of programs for other more reverse lenders that are coming up with their own second programs. So this program seems like it's going to become one of the popular ones, as well as HECM or proprietary loans. Okay, so the HECM program, as I've mentioned before, it is FHA insured. The borrowers can receive the funds in a lump sum, line of credit, or they can select a monthly payment. Depends on what your borrower needs and what they would like. Ideally, the property would be anything that is valued to the $1,209,750, which is the FHA lending limit. Anything above that, they will just go based off of the max number here. Do you guys have any questions so far? Let me know if I'm going too fast too, because I don't want to go too fast. Okay, so I do have 2 examples of the HECM here. So this first example here is for someone who is age of 62, so they just turned the age to qualify for this program. The value of the home, I do have it at $1 million, with a current first lien of $200,000 that they have to pay off. Okay, the margin here it was already predetermined. However, we are able to change that margin, but I didn't change it. This margin is at 2.625. With all the payoff amount that they are going to pay, any fees, the borrower is eligible for 83,964 64 with 65 cents. The first year, they're only able to access 31,000. Okay. After that first year, they do have that line. This one here is selected as a line of credit, but they do have access to the funds. However, if a borrower was 75 years old, same scenario, 1 million home appraisal value with a first lien of paying off of 200,000, this borrower is now able to get 171,964. So the older the borrower they are, the older they are able to access to have more, not more equity, but the funds become a little bit more higher. So it's always when your bars are just set 62 and their first lien is very high, there's a high chance that they won't qualify and get enough funds that they are wanting to get. So HECM, it's not really based on the loan to value most of the time. It's really based on age. Okay, so I have the chart here for the rates. So again, this is the margin here that we had selected, 2.625. The PLU here, this percentage here, let me go back. It's going to be this initial loan balance. So this percentage here, 73, and then this one here at 57. That's what that range is. So for the age of 62, it was 73%. Your rebate for that 2.625 margin, your rebate would be 4.38. Now, if second scenario, bar 75, their percentage was at 53, your rebate would be 5.35. Again, if you have a lower margin, the rates will change as well, or the rebate will change. You guys have any questions here? Okay, so the HomeSafe Second, HomeSafe, which is the Finance of America's proprietary loan, it does qualify for any of the homeowners that have that are 55 or older. So if you have someone who is not at the 62 limit that could possibly qualify for a reverse, this is definitely a great program to try to qualify them for. They don't have a FHA limit, so they can qualify for up to 4 million. Unlike the HECM, there's no mortgage insurance premium in them. It also has a growing line of credit. So for this one here, I have two same examples just for their proprietary program. Again, the rate on this one is set at 9.24, but I believe it can lower to a different one. I'm not too sure if there's a cost or not, but it did give two options. Same scenario, same value, 1 million, paying off 200,000 loan. So borrower at 55, they could qualify of getting a lump sum of 130,000. Now that same scenario for a borrower who is 75 years old, they qualify to get 239,000. The rates here, based off of their rate sheet, like I said, it did have this 8.974 option, but I wasn't too sure what, if there was a cost or not. This is personally have never priced out a proprietary loan with them, so I'm not too sure why there's two different rates. Like I said, when I set up these examples, the 9.25 was the standard rate that was already on there. The HomeSafe Second. So, like I said, the HomeSafe Second is a HELOC option for borrowers who want to keep their current first, especially if they have a very low interest rate. They do have to make sure that they are paying that first lien. And let's say they just want to consolidate some debt, do some home improvements, they could qualify to get this HELOC. They wouldn't be paying the principal and interest, like the reverse, same thing as a reverse. They don't pay that principal and interest. They do just have to make sure that everything else is being paid. And they do have to have a strong financial assessment. They have to have strong credit for this HELOC, for them to qualify for this HELOC. This example here, the rate was at 9.9, same thing as the proprietary. It did have a second lower rate here. For the age of 55, they could qualify for $136,000. Again, this one, they're not paying off anything. For the age of 75, they could qualify for about $186,000. These are the rates. She has been really good about providing the updated rate sheets. I think I saw them the updated ones come in this morning. These were based off of the last rates when I was doing the presentation. Please note that for the HomeSafe Second, there is a $3,995 flat fee, but that is to Finance of America. So we would only get, I believe, the compensation on this side, the rebate. Okay, to qualify, unlike a regular conventional or FHA loans, we don't go based off of DTI. To qualify them, we go based off the residual income. So residual income is the amount of money the borrower has left over each month after they paid their monthly debts. This is a key factor in their financial assessment. So to ensure that the borrower is able to manage their financial obligations. So they want, ideally, for the residual income to qualify, it must be greater than or equal to the FHA limit for their specific geographic region and family size. So how do we calculate the residual income? The borrower's residual income is calculated by their monthly income after it's deducted from all of their expenses. Okay, so let's say they receive Social Security, pensions, let's say they have VA, all of the income that they receive, they're going to calculate everything, and then they're going to calculate all of their expenses. So credit cards, any alimony, any car payments, any mortgage payments, everything is going to be added, and then they're going to subtract that. Okay, I have a chart here for that residual income. So based on the family of one, so let's say our borrower lives by themselves and they live in the South area. Their residual income, after they've calculated all their monthly income and subtracted all of their monthly expenses, they should have $529 or more left over for them to qualify. Okay. Down here, I do have the states based on what geographic region they are located. So California is the west here. So if the bar, let's say the bar qualifies, they live with their spouse. So their residual income will be calculated based on the family size of 2. Even though the spouse may not be on the loan, they will do the residual income based on the family size of 2. Note that the borrower's spouse, if they are a non-borrowing spouse, they still have to provide their age, and they will sometimes they do also have to do attend their counseling. They do have to sign information because this is FHA for HECM. We do have to take in consideration the spouse's liabilities as well. Just like a regular FHA loan, we would also include the spouse's debt to qualify and make sure that their debt DTI works. Any questions with the residual income? Okay, our fees. So for the HECM, you are, well, for most of all of them, you are able to charge an origination fee. For the HECM, however, the max you can charge is $6,000. There is a upfront mortgage insurance of 2% of the home value, plus a monthly mortgage insurance of 0.5 of the loan balance. Like all other loans, there will be appraisal fees, title escrows. The lender will have a monthly servicing fee. I believe I think it's like less than like $50. For HomeSafe, their proprietary loans, it's based on the loan amount. I think from what I was researching, we are capped at 3% for our origination for the HomeSafe. Like I mentioned before, this HomeSafe does not have a monthly or a mortgage insurance premium. Again, we'll also have to have an appraisal, title, escrow. The HomeSafe Second as well, it is varied by the loan amount. However, I'm gonna have to get back to you guys. I want to say the origination that is charged is at like the $3,995, and it goes to the broker, to the lender, I mean, and we just get the rebate, but I will double check on this one. So, LESA, okay, in case you guys aren't sure, you can kind of think of this as the escrows. So what is LESA? So LESA is the life expectancy set aside. So if our borrower has not the best credit, they have some late payments, or their financial assessment failed by like a little bit, they might reconsider it. And as long as they say, okay, we'll do the loan as long as we have a LESA account. So what this is that they are going to take out money from the balance that they are going to get and set it aside to make sure that the taxes and insurance are going to be paid. Okay. The LESA, I would say from previously when I've noticed it, when I've had to work with it, it takes a big chunk of the money when the money that the borrower would be getting, but it is a way to qualify them. So it might be something to look into.